I think one thing people don't appreciate, for example, in this rate rise that we may potentially have, 200 bips of rate rise is like 12 to 13% to S&P earnings. So imagine if you took S&P earnings down 12 to 13% next year, and on top of that you took the demand destruction that comes with a 250 bip rate, 200 bip rate move, and the market's getting cut in half. I mean, I'm saying 40%. So I think the market's down 20 to 40% in the next 18 months.
I think that qualifies as a bear market then, under those things.
And as sort of sad as it might seem, retail investors are really good at doing the wrong thing on both the top and the bottom, and make for a wonderful indicator.
Yes.
Yeah, I mean, people aren't spending any money on R&D anymore. If you look at it, it's all a big financial engineering scheme. So if you look at the big pharma companies, for example, if you look at their R&D levels, they're as low as they've ever been. They've basically taken the MO that why don't we just not spend money on R&D because we get a big multiple on earnings and R&D hurts earnings, and instead we'll go buy companies that spend a ton of money on R&D. So it's basically sort of this backdoor way of spending R&D and driving your multiple to look like it's less because you don't have that expense running through the P&L. Right? The traditional way to do it would have been to go just develop the drug yourself. Don't wait for someone to go do it and then go pay $20 billion for it. There's financial engineering that's going on, right? There's a little bit of gaming that's going on. And I think companies like Apple, I mean, they just have so much cash. This is lightning in a bottle number 2 for Apple. Apple's now about to become the 4th biggest cell phone manufacturer in the world. Their unit sales are down. There's 6 billion cell phones floating around the world. And they don't have anything else, so they got to buy back a ton of stock. But it's just this lack of running it through the R&D line, right? It's a lack of spending because they know the market rewards, multiples on earnings. And well, if you spend on R&D, you don't earn money. So just borrow money and go buy what you want.
Yeah, one of the fascinating things about oil and fracking is that fracking companies don't make any money. The cash flow isn't there. These wells get drilled. They have much faster production curves than normal wells, which means you have to spend a ton of money to get to the oil. You get good production for a year or 2 years, and then it starts to peter out. If you look at free cash flow, you really wonder how sustainable this cycle is.
We're a real bank doing lending all day, every day to both individuals and commercial entities. There's definitely a slowdown occurring in lending. We're seeing loan paydowns. This began last year, and it accelerated into the year, and we've seen it all year this year, and it's harder to find loan demand. So this is real. Another indicator that I would look at, and I'm actually surprised that it's moved so far so fast, have been the home builders. If anyone's not paid attention, these guys have been absolutely crucified this year. And it's been obviously a good year to own equities, and these guys have been just tattooed. So as someone that sits on the front line and sees what mom and pop businesses are doing all day, every day, I'll tell you that they're borrowing less money than they were. They're paying back money at faster rates. Defaults don't exist thus far, at least in our world. We've not seen defaults on loans. Property prices have held in. But those that we're using, and I'm talking about high net worth and mega wealthy individuals that were using their own balance sheet, are doing less of that than they once were as a result of the tick up in rates.
But if I'm a pension fund and I have 20% of my portfolio in alternatives that are not mark to market, okay, I can list down the values based upon investments. I mean, I'm not saying anything nefarious here, okay, but it just seems to me that it would be something that would be helpful to pensions.
To not have to mark. I think it's helpful to the career of the allocator that put the money in there because they can't get fired in 6 months, and when it hits the fan, they're going to go get a new job before it has to be mark to market. So it's a wonderful career management behavioral
Well, it's kicking the can down the road.
Right? It's beautiful, right? You don't have to know what I have in my book because I don't have to tell you, but I know what's in there, and when it gets nasty, I will leave. I personally think it's unethical. I understand that private equity's driven nice returns for people. I understand that small caps have disappeared to some extent. I understand these big pension funds need to access that side of the market, right? So if they're doing it because of that, it's a reasonable, fair way to do it. But if they're doing it just for mark-to-market reasons, then they're people that you shouldn't go near.
The reason to invest in privates isn't because you can hide your losses in some sort of accounting gimmickry. That's crap. The reason why you should invest in privates is because there's some sort of mispricing there that you can take advantage of, and this is what I was talking about when I said if you could trade some of your liquidity, if you didn't need all of your liquidity and could capture that in the form of higher returns, then that makes a lot of sense. There's a lot of bums that sit in these asset allocator seats and they see value in the seat. This is no different than in the long-only world where you had people saying things like, oh, well, you can't get fired for owning Philip Morris or IBM or GE, and guess what? You can, and you should. And they should carry these bums out because they give the industry a bad name.
You know, with the SALT deduction caps, Trump basically put a bullet in New York and California. They're done. They're done as we know them. Everyone's leaving those states. All the rich people are going to leave first, and then the tax rates are going to have to go up more, and then everyone's flooding out. So you look at places like Florida, and you look at places like Texas, right? Especially as we have these massive deficits, and we have no deduction on 13, 15% taxes in New York on the state level, and then that federal rate's going to start moving back up. You just have no incentive to stay in these places.
What's really important here, I think, is to play good defense. Know that we've had a tremendous run, and know that we're likely getting close to the end of a cycle, but who's to say when it's going to occur? And to really think how you want to allocate, how much you want, to have in cash, and how much you want to have more aggressively, and to try to balance that opportunity cost with the risk of the downside.
I think this is one of those issues where both Donald Trump and Bernie Sanders are on the same page, and they would be united against China in this sort of trade war issue. If you look at developed economies, the U.S. had the absolute lowest tariffs at about 3, and Chinese were the second highest at nearly 10. And essentially, the administration has come to China and said, listen, our goal is to keep tariffs as low as possible. We're at 3. We'd like you to be there. If that's not the case, then we'll match you at 10, and that's where we'll be, and it'll hurt both economies badly. I think it ends up getting resolved. I think the Chinese are somewhat of a paper tiger because they recognize they need us. There's no one that can pick up the slack. The Japanese can't do it. The Europeans can't do it. And so for everyone's benefit, this hatchet will get buried, I think.
And if rates continue this rise, the economy is going to be different than it was over the past 10, 15 years. I am a specialist in, gold stocks, gold companies. I'm not always a bull on gold, but I think the stars are aligning right here.
Yeah, I think just being defensive is not just to be defensive, it's so you could be offensive later. So don't forget that, right? And as you're sitting here figuring out that defensive position, it's, you work just as hard, but you work at what will I do next, right? And so I think I'm excited. I think it's an exciting time. I think obviously drawdowns are difficult, but if you do the right thing, that's where you make the most money, so.